Welcome to Early Edge Club. Before we deep dive, we are opening Early Edge Club to a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company we are analyzing today is Madhya Bharat Agro Products Limited. It is part of the OAL Group of industries. They basically manufacture fertilizers and specialty chemicals, mainly focused on phosphatic agri-inputs. And they have a B2B model. So they have a very strong distributor network of over 2,500 wholesalers, 30,000 plus retailers, and 170 plus marketing staff. And they sell their products under their own Annadata brand. Earlier, their entire sales came from a single buyer model. This was back in 2016, 8 to 18. But after that, they realized that it was no longer viable due to some shifts in government policies, etc. They changed their entire business model and started manufacturing and selling under their own Annadata brand. So some of the products which they deal in are single superphosphate, both powder and granular format, and diammonium phosphate and NPK, which is nitrogen, phosphorus, and potassium fertilizers. They've basically backward integrated into sulfuric acid, phosphoric acid, and beneficiated rock phosphate, which are inputs to manufacture the DAP and NPK fertilizers. So they've basically backward integrated and started manufacturing their own raw materials. And this was to basically secure low cost raw material supply. Their sales follow crop cycles, but mainly they are broad based and they are not reliant on any single large orders or government tenders, and they are backed by recurring demand. Of course, there is some cyclicality based on quarterly earnings and like when the cropping season starts and when there will be monsoons, etc. So there is some kind of natural fluctuation, of course, but other than that, it is more or less stable. And they shifted from a single buyer model 2018 onwards. So these are basically some products which they manufacture. Yeah, if you have a look at it. So moving ahead. So this is one slide where they had explained how they are a fully backward integrated manufacturer. So they started manufacturing beneficiated rock phosphate, and they procured long-term agreements with Egypt, Jordan, and a domestic supplier for the supply of this rock phosphate. So they convert this rock phosphate from a low grade into a high grade material. And when they use this along with sulfuric acid and water, so sulfuric acid also they've started their own production. So once they use these two materials, they can manufacture SSP, phosphoric acid, and along with SSP and phosphoric acid, when they combine sulfuric acid, that's when they start manufacturing ammonia. And from these multiple inputs, they then start manufacturing NPK and DAP, which are the fertilizers. And then they use NPK and DAP to make complex fertilizers as using these two as raw materials. So this is their entire manufacturing process and how they've backward integrated into BRP, sulfuric acid and phosphoric acid. This is how they've explained. Now coming to their business segment breakdown. So right now they have two manufacturing plants. One is in Banda in Sagar and the other is in Rajao village in Sagar. Both of these are located in Madhya Pradesh. And they have also planned a mega fully integrated plant to be commissioned by October 2026 in Dhule, Maharashtra. They've already spent around 100 crores of CapEx on this plant. And yeah, you can see some of the capacities of all the different products in this column. And the benefits of these are that they are extremely close to either both their raw material supply locations and also to the markets to which they cater. So it is very strategically located close to the rock phosphate mines and to the sulfur sources and also to the irrigated market. So all these plants are very strategically located and their capacity utilization for different products is mentioned here. So BRP is 1,89,000 tons Sulfuric acid is 1,65,000 tons, phosphoric acid 69,000 tons. And sulfuric acid is currently running at 100% capacity. So earlier it was 100%, and then there was some capacity expansion in fourth quarter of FY25. So that's why it fell slightly, but now it's again back to 100%. Yeah. And the fertilizer capacity, so DAP and NPK is at 100%, and SSP is running around 80%. So that is 240,000 tons each of annual capacity. Talking about their management, so they are a competent and experienced leadership team, and they have strong academic backgrounds, and they have a clear track record of stable operations, financial prudence, and governance, and they have decades of experience. So this is the father, Mr. M.K. Oswal, and he has more than 4 decades of experience in this industry. And both his sons, who are Pankaj and Praveen, Pankaj Oswal is the MD of this company, and he is a CA with over 24 years of experience. And Praveen Oswal is also a CA with 21 years of experience in this field. And none of the promoters or management have any involvement in regulatory or legal issues. So yeah, they maintain high standards of corporate governance. Talking about industry analysis, so India's fertilizer market is, as of 2024, was worth $43 billion, and it's projected to reach $74 billion by 2033, growing at a CAGR of 6%. Some of the key players are Coromandel, Chambal, and product demand is mainly led by urea and the diammonium phosphate and nitrogen, phosphorus, potassium fertilizers segments. And IFCO is basically stands for Indian Farmers Fertilizer Cooperative Limited. So it's a cooperative. It is one of the major manufacturers of fertilizers in India. And MBAPL, which is our company, is a niche regional player in phosphatic fertilizers and it has a very strong backward integration, which is actually one of their moats, because none of the other players in India have this integrated supply chain. The sector is mainly shaped by policy reforms, subsidies, sustainability push, digital agri-tech, and raw material security. And there is high competition, and market usually favors these integrated players with regional scale and product diversification. So their FY21 to 22 revenue grew substantially, almost grew 9 times. After that, there was a slight dip in revenue in FY24. And this was mainly because of lower realizations, whereas while their input costs remained stable, so their revenue took a hit there. And yeah, but overall their revenue CAGR over a 5-year period has been 63. So that is, the company has grown very well. Even their EBITDA, a similar trend, but at a 37% year-on-year growth. So it's very good. So as I said, due to the revenue fall in FY24, their ROCE and ROE also took a hit. But now in FY25, it has slightly rebounded due to better profitability. So as you can see here, the PAT jumped from 25 to 57, which is why mainly their ROCE and ROE improved. So now coming to the future outlook and management commentary, they are basically planning capacity expansion. As I already told you, the fully integrated plant at Dhule, Maharashtra, that is one part. And they are also setting up a sulfuric acid plant at their existing Sagar, Madhya Pradesh facility. So these are all the details of where they've spent their amount and how much progress they've had already. And I've already covered the capacity utilization. And yeah, so they've already completed one project of uric acid plant at Sagar for around 70 crores. And that started in March 2025 recently. So the capacity has expanded to 69,000 metric tons, up from 49,500 metric tons. And their immediate focus is on optimizing their capacity utilization as of now and implementing brand promotion activities to enhance their market visibility. And in their FY26 May 25 con call, they had mentioned that they expect to see tangible benefits from this investment, which is the CapEx which they have incurred. And accordingly, they see a revenue growth of around 15% in FY26, along with better profitability. Now coming to the bull case, they have a very strong moat, as I mentioned, because they are the only fully integrated player with backward manufacturing ability, which they use for BRP. So they beneficiate the low grade rock phosphate into high grade. So they are the only one in India for that. And this backward integration will protect them it will basically de-risk their input cost, and it will provide them secure and cost competitive production capabilities. And it reduces exposure to their global price volatility and supply shocks. The group has entered into a long-term agreement to procure rock phosphate from Egypt in April 2024. So again, that clears their input cost volatility. Their niche strength is focused on zinc, boron enriched single superphosphate and DAP. And they have a very strong hold in Madhya Pradesh and central India. So states like Maharashtra, Gujarat, UP is where they cater most of their revenue. And so they have a very strong hold in the central Indian region. Their greenfield integrated DAP NPK plant with a capacity of 3.3 lakh tons and captive acid units at Dhule, Maharashtra is on track for commissioning on as of October 2026. So this will boost capacity and drive growth from FY27 and beyond. Again, they have adequate availability of land, infrastructure, and inputs to expand capacity in the future, even though right now they have existing unutilized capacity. But in case they need to expand in the future, they have sufficient headroom for that. And they have pricing freedom because they are a complex fertilizer manufacturer. So there are no direct government restrictions on their pricing. Now, coming to the bear case, they heavily rely on government subsidies. So any delays, cuts, or policy shifts can severely hit their cash flows and solvency. So I've just taken a screenshot from their revenue from operations here. So around 32,000 out of 81,000 comes from government subsidies. So they are basically heavily reliant on government subsidies for their revenue. There is margin pressure from raw material volatility, even though they have backward integrated, but still there exists raw material volatility, input volatility to that. They have high debt and finance cost because all their aggressive CapEx plans have been debt funded. And yeah, execution delays can amplify their risk even further. Then there was a sharp FY24 revenue and margin fall, as I explained already. So there are chances that the market may underestimate the recovery challenges from this fall. Again, there is intense price competition in non-complex verticals, so that limits their pricing power in the NPK and DAP verticals. And regulatory or policy shifts towards organics, bio or nano fertilizers could hurt their main products, as these products are not organic. And their high working capital usage and receivables raise liquidity risk. So now I'll cover the 20 factors for. So their IPO was in Jan 2017 and it was a pure OFS, so no funds were received by the company. And the main reason was carrying out the sale of the shares of existing holders and enhancing brand name and visibility and funding general corporate purposes. But they didn't need any funds at that time. So I've just given a 5 because all their expansion was either debt funded or internal accruals. So their MD's name is Pankaj Oswal. He has 0.94% in the company. Praveen Oswal is his brother, 1.52%. He's the non-executive director and he's the chairman and non-executive director. He holds 0.19%. This seems low, but shareholding exists mainly with the holding company, which is Oswal Phoschem India Limited, who holds 65.1% of the company. And their track record was all clear. They weren't involved in any issue. So I've given them a 5. Coming to related party transactions, this was an area of major concern. So they have given a loan to their holding company of 17.5 crores in FY24 and another loan to one of their sister companies, which is Krishna Phoschem, of 20.9 crores and another loan given to Shri Ganpati Fertilizers, which is another sister company, of 22 crores. So all these loans were extremely high amounts. And also there was a purchase of material worth 86 crores from related companies, which was mainly the holding company and Krishna Phoschem again. So that was 86 crores and another sale to Krishna Phoschem of 22 crores. So these were extremely high amounts and there were a lot of related party transactions. So for this purpose, I've given them a 0. Independent directors were 50% and there was no promoter family dominance. So I've given a 5 there.
This part, part you're covering.
So salary was also quite within limits, nothing major. So again, a 5. And there was no CEO, CFO resignation. And there was a change in auditor, but it was due to expiry of term, no resignation. So I've given a 5 there. Auditor opinion and credit opinion was also clear and stable. So again, 5. And as I said, they weren't involved in any regulatory issues. And they had all their investor communications and disclosures in place. So I've given a 5 there as well. Okay. So now coming to the business concentration risk in FY16, which was basically I already mentioned this, they were supplying 99.93% of their revenue came from sales made to DC and Shriram. And this was back when they weren't selling under their own Annadatta brand. But now they've diversified and they have a huge customer base. But still, their customer concentration was not disclosed. So I couldn't judge anything based on that. So I was given a 3. Yeah. So lower realizations and stagnant input cost caused the FY24 revenue dip. And in FY22-23, there was a surge due to significant increase in production and sales volume. And they commenced their operations in DAP and NPK. In FY22, their inventory grew 5 times, which was mainly linked to their capacity expansion. And FY23 receivables tripled in line with revenue growth. So for this reason, their operating cash flow to EBITDA became very negative in FY22 and 23. But post that, again, there has been a very good recovery. So I've given a 5 for that. And historically, they've always had a very positive operating cash flow. Only in these 2 years, there was a slight concern. Coming to inventory trends, their inventory days are long, but they have been controlled. And the same thing, DSO has also increased, but overall it's in control. And receivables are growing steadily in line with their revenue. So I've given a 3 year because it is long, but it's not, it's growing, but it's in control. But their cash conversion cycle is extremely stretched. In FY24, it reached 188 days. So it seems that their receivable days are, even though they are growing a lot, from 50 to 51 to 86, the payable days are hardly increasing. So there might be a chance that the suppliers aren't being easy enough with them, and they have to rely a lot on their short-term borrowings. And so inventory and receivables are mainly what is stretching the cash conversion cycle. And historically, their fixed asset turnover was around 1 to 2. But post the major CapEx in FY21 for setting up the mega plant in Sagar, their fixed asset turnover has started increasing. So after that, it has always been 4, 3, 6, around that range. And so there was higher revenue from the single superphosphate and NPK, which caused the higher fixed asset turnover. And even the total asset turnover has increased post that. So I've given a 5 there. And their debt equity has been increasing because they are using debt to fund their CapEx. And the debt is high, I would say, but they are generating sufficient profits to service the interest obligations. So that's why their interest coverage ratio is 4.4. So it is high, but it is not a very big concern that they won't be able to service this debt. So I've given a 3 here. And their industry average quick and current ratio stand at 0.7 to 0.9 and 1 to 1.3, which is the company has higher ratios than this. So I've given a 5. And ROE and ROCE, historically they've had decent values. In FY22 and 23, as I mentioned, because of their extreme growth and high profitability jumps, their ratios jumped. But post that, FY24, that caused again because of the fall in revenue. But historically, they've had an average of around, I would say, 10 to 15%. So I've given a 3 for that. And coming to growth consistency, their revenues have been growing quite well. And their margins have also been not the best, but right now they've fallen again. But historically also they were decent. So I've just given a 3 for that.
So just looking at the financials, I'm not sure if you analyzed this. Do you have any idea? They were doing a pretty decent margin of 19, 20, 23%, until 23. And it has fallen down to like low teen numbers. Were you able to dig in as to what the reasons were?
So mainly what their thing said that after their FY24, what happened is since their volumes fell and the input costs remained the same, they weren't able to recover as fast as they had been growing previously. So that was the reason why their margins took a little hit. But other than that, I am not sure exactly why.
Like 10% lesser than what they were doing in 23, approximately 9%. Okay. Yeah. Anyway, a lot of fertilizer stocks have been doing good. One of the reason why the stock is doing good now is because whenever you see, they always try to correlate with the rains and the monsoon season. If the rain is good, fertilizer stock tend to do well. So predictions for this year are that there's going to be normal amount of rainfall. There's not going to be shortage. And when that happens, demand for these fertilizer stocks tend to go up because of the sowing season being normal. Having said that, they've grown really well. A lot of CapEx in terms of backward integration, etc. Margins is one place where I would like to see how the margins pan out. To be conservative, what is the growth they're forecasting?
So in their con call, they had mentioned around 15% growth in FY26 is what they are targeting after the commissioning of the
Okay, so I
their new
heard the
plant.
con call. They said for this year it's 15%, and then they'll give a revised guidance once the plant is commissioned, because then they'll have much more information with them. Yeah. So basically,
Correct.
yeah, if you're taking 1 year
Yes,
for
that's right.
target, then this is a closer number to 15%. So we'll go with the worst case. Margins are going to be around this level. And yes, as again, PE is at a 50 PE, looks stretched. And if you're giving a value of 50, it then gives a price target of 471. The current price target is 442. So until and unless the PE stays at this level, the price even at current level looks stretched. Any PE derating is the risk that you have to consider. So need to go deeper into the growth drivers and the levers. But let's see, taking a longer time frame. They have done a huge capex, so free cash flow is negative. So let's the try to take the operating cash flow. It has fallen a bit in FY25. It's 96 crores. Let's see what the PAT is. PAT is at 74 crores. So let's be conservative and take PAT as the number. So if the PAT is 74 and your required return is 20, these numbers are subjective. So based on your calculation and estimates, feel free to change. I would be more conservative with the 5-year terminal multiple of 25. And if we calculate the required growth rate that is required is 35%. So looks like a lot of things are already factored according to me in the current price. So until and unless I am missing something and the company is going to grow at 35%, the current price factors in a lot of upside potential. So one, there's no margin of safety is what I feel in the current price. And two, there's no optionality or triggers available based on our initial analysis. But then overall, the company is good. Fertilizer sector, because of subsidy, is one reason I generally don't try to invest, because there is subsidy risk, which is a major factor for me. So having said that, do the due diligence. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with us. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.